Hi everybody, I'm Bonnie. I want to first go through a real high-level overview of the Affordable Care Act. At this point, I'm sure everyone's heard about it probably 100 times, but the way we thought that we would go through this is that I would talk about a specific section, and then Chris will show you how to do that on our system. So with that, I'm going to get started. For the overview, basically, what happened with the laws were they mandated that everyone must have health insurance. So to make that happen, they set up the exchanges, state exchanges, for everybody to get health insurance if it's not offered from their employers. Then they also made a mandate for the employers that they had to offer the health coverage, or they were going to have to pay penalties. So what does that mean to the employees? Employees, in addition to the employers, are going to have to pay penalties if they don't have coverage. So if any employees that don't have the coverage will get a penalty or assessment when they file their taxes. In addition, if they do go to the exchange to get health coverage, they may be qualified for tax credits. So what the IRS has said is that if an employee goes to the exchange and gets those credits, then they're going to turn around and penalize the employers for that. There's going to be two different types of penalties for the employers, and basically what that means is that there's going to be a penalty of the $2,000 if an employer does not offer coverage, and then there's going to be a $3,000 per employee penalty for anyone that's receiving a tax credit. So if you offer the coverage but it's not affordable to the employee, they go to the exchange and get a credit, then you're going to get a $3,000 penalty for that employee. So what do you have to do so that you don't get these penalties? Actually, at this point, you can make a choice. That's why they're calling it the play or pay. You can choose not to do this and just pay the penalties, or you have to go through all these different steps and offer the coverage and do what you need to do in order to not get these penalties. So here is, at this point in time, everybody pretty much is behind the gun. There was a lot of things going on through the year. They made some changes last minute and things like that, but here is where you should be in this process for the 2015 filings. Step one, you should have determined if you are ALE, and basically what that means is that, you know, how many employees do you have that average over 30 hours a week? If it's 50, you should be supplying these forms and going through the rest of these steps. You then need to determine if your current health insurance meets the affordability and the minimum value. Basically what that means is, I don't know if you're familiar with or how familiar you are with health plans or anything like that, but I do know that on the exchanges there is gold, silver, and bronze plans. And basically what that's saying is that you have to at least offer coverage that meets the bronze plans that employees can get on the exchange. And in that case, you want to talk to your insurance providers and that kind of thing to make sure that your plans are covering the minimum value and minimum coverage. Step three, you need to set up all these look-back periods and different things that you need to do to measure those. The first thing you're going to need to do is figure out, after you figured out if you're an ALE, now you need to start measuring the employees, and usually that's done on the prior year. So you want to set up your plans. You want to set up your periods, and then, and we'll talk a little more about that. Then you need to monitor your new employees in step four. Once you got everybody set up and they have been offered the coverage and they're getting insurance, now you got to monitor your new employees and identify those that may require to be offered coverage within a 90-day period. And then step five, and this is hopefully where everybody is at this point in time, compiling all of the data to be able to produce the forms 1095-C or 1095-B to all those employees that are receiving coverage. And then the last in the step is that all that information then has to be sent to the IRS for them to determine if any penalty situations apply. So the first step is determining if you're an ALE. And basically what that means is that you have to come up with a measurement period or a look back period. And it's usually the prior year. So in my example, I want to go through a standard pure vanilla period. It's based on pretty much a plan that begins the first of the year. The first one you would do is your measurement period. And this is basically where you are identifying all of those employees that are over the 30-hour full-time status. And they are the employees that you have to offer coverage to. So in my example that you'll see shortly, the measurement period that I'm going to use is from October 13th through September 14th, which is the prior year for the 2015 reporting. So once you offer or find out all of those employees, I'm still on the ALE, sorry. To determine the ALE status, you first need to figure out all of your employees that are over the 30 hours. And then you also have to include all of those employees that are under the 30 hours. What the IRS has said is that you're not only going to count the hours of full-time employees, but you also have to count the hours of those people working under the 30 hours. And so to do that, basically what you do is you add up all of the hours of those people under the 30 and then divide it by 120 hours to determine how many of those people would be considered full-time to come up with the over 50 employee refiling requirements. You also have to consider if you're a group or related company. If you have multiple FEINs or any companies that are related or in any way, they all have to be considered. So if you have a small company with their own EIN that only has like 30 employees and maybe 15 of them would be considered full-time. And then you have another company that maybe has 500 employees and quite a few of those would be full-time and put you way over the 50. You would also have to include that small company in your control group and in your reporting and your offers. Also seasonal employees, there's special rules for seasonal. If you go through this calculation, if you have seasonal workers, you can go through this calculation and determine how they fall into the category of being an FTE. Okay, now Chris is going to talk about how to come up with your ALE status.
Okay, so everything that I'm going to talk about with utilizing the FMS tools all revolves around our PPACA average hours report that we rolled out last year. This is accessed from the payroll employee reporting menu. So from the payroll main menu, you want to go to employee reporting, and down at the bottom there's healthcare reform report. I also like to call it the average hours, PPACA average hours report. So if you haven't already run this report, you definitely should have by now, but if you haven't yet, we've done some enhancements to it over late last year and into this year. But this is a report that's we're trying to give you as much information as we can to assist you in calculating all of these different steps. This is basically a Swiss Army knife type of report. It can be run for a range of clients, any kind of date range period. So this is a look back report primarily that's going to give you, it's going to basically print one line per employee that gives you their wages and deduction information. There's a couple of setup pieces that I'm not going to get into on this webinar. We have a webinar on how to run this report if you look again at the YouTube website. But essentially you designate earnings codes to add up wages. If you want to exclude earnings for whatever reason, I don't think any clients that I know of are excluding any wages. You still include non-productive wages according to the IRS as far as we know. So and then from the deduction side, you also flag which deductions are your health insurance that you're really testing, And when this report runs, it will pull the premiums that the employees have paid so that you can calculate affordability. So again, we're trying to do as much as we can in Swiss Army knife type of report. This audience has a full library and full menu access and can download files. So my recommendation is to use the data transfer download, and if you don't have it, we can get it to you, or you can build one yourself, of course. The file, when you run this report from FMS, it creates this file, XHCR report, and you can download it to your desktop as a CSV file so that you can manipulate all this data in Excel. I shouldn't say manipulate, but utilize. This is what the file looks like when I run it, if I open it in TextPad, let's say. Okay, so it's just each value separated by commas. But then, of course, when I open it in Excel, everything is formatted. You can just save it as a CSV when you use the download for the data transfer, and then this is the Excel version of it. You just open the CSV file in Excel, and you're going to get something that's formatted like this. So we've got employee number, their company, corp, store, department, name, their current status, if they have a job code, their current hourly rate, if they're hourly, if they're salary, the rate's going to be 0, their hire, rehire, and term dates, and then the number of pay periods that they were paid in the date range that I ran it for, okay? Total hours, and then we divide hours by the pay periods to get average hours, total wages, which of those wages are flagged as taxable in the system maintenance, affordability I'll get into, the affordability ceiling, the total insurance premiums, average premiums, a lot going on here. And then this on the end is a calculated field I'll talk about in a bit. So we've got a lot going on here, from deductions to wages to hours and all the information that you will use to calculate these steps. So that's kind of an overview of this report. We'll be using this report primarily. And what I've got down the bottom here, the blue tabs, are my raw data. I like to call it raw data. And that's just, I've run it for the entire year, my look back period of 2014. And then I've run it for 2015 of January, February, and March, just to give us an example to work with, okay? And so for 2014, that's our look back period to determine what we're going to use in step 1 for the ALE status. So the first thing that Bonnie was talking about was first determining full-time employees. This particular example that I've got, the salary employees do have hours. And so let's keep that in mind while we're working with this data. Not all clients track hours for salary and employees. So you'll need to take that into consideration when you're using this report, because if you're just loading dollars only for salary employees, you're not really going to have their hours, obviously, and most of the time your salaried employees are full-time and they're going to get an offer. So you'll really want to, you can kind of group them together and handle them that way, and then just any exceptions that you have, like a part-time salaried employee, which is theoretically pretty rare. So to start out, we're going to use the average hours for the year. So I'm looking at, this is my report that I ran for the entire year of 2014. So the first thing I want to do is add up, I have filters here turned on in Excel. And so the first thing I'm going to do is look at anyone that's greater than or equal to 30 average hours. So down the bottom left-hand corner, it's telling me I'm coming back with 186 records. So I've got 186 records, and that's 186 employees that are full-time, that have greater than or equal to 30 average hours throughout this entire year. And one thing also to keep in mind, I was getting ahead of myself probably by doing it for the entire year. This exercise that I'm performing right now should theoretically be done by month so that you can determine if you have 50 or more average employees by month. So really you want to look at what your average employee count is by month, and if you've got 45 some months, 55 some months, you really, according to the law, you average it out across your entire look-back period. So that we're going to perform essentially this exercise. I'm going to do it once as an example, but we would really perform this by month during your look back period. Okay, so let me get back to where I was. So we filtered this list and we found that we have 186 full-time employees. Okay, and now we're going to do the full-time equivalents. So the full-time equivalents is those that are under 30 hours average. So let me clear my filters again, and now I'm going to do a filter for less than 30. Okay, so here I'm working with mostly my part-timers that are less than 30 employees. So the way that we calculate the full-time equivalents is first of all, we limit the total hours to only, I was going to say 120. And again, this is by month. So let me switch over to my January data just because I can't really go with the annual too much longer here. Here's my hours. I'm going to filter again less than or equal to, or less than 30, okay? And I'm going to take out zeros as well. Well, let me just sort this thing. So here I'm looking at employees with hours, excuse me, I need to go with average hours less than 30. I want to look at employees with average hours less than 30. However, to calculate full-time equivalents for these employees, we're going to look at their total hours, and we're going to first we limit them. If anyone is more than 120, we limit them to 120 total for the month, and then we add up all of these hours and divide by 120 to give us what we call what the IRS calls full-time equivalent employees. So the easiest way to do that in Excel would just be a formula, like an if formula. If the hours are greater than 120, then limit it to 120, otherwise give me the hours. Okay, so if I drop this formula down with double-clicking the bold corner there, I'll drop it down all the way. So for example, these employees here that have greater than 120 hours, I'm limiting them for the month at 120 hours. And so now I want to total these hours, and I can just do auto sum in Excel and go all the way back up to row 1 or row 2 after my header. And so I've got a total of 25,512 hours and a half hours. So basically I'll just take another formula that down here in this cell, and I'll say, okay, take that and divide it by 120 hours. So essentially, again, so each full-time equivalent employee is a block of 120 hours. So after we've taken the 120-hour blocks, we come up with 212, and I believe we're rounding down. Yes, we're rounding down. So we've got 212 full-time equivalent employees plus our 186 full-time employees. So obviously we're well above the 50 employee limit. So we definitely are an applicable large employer at this point. And to Bonnie's point about the control group and related companies, this exercise needs to be done across common ownership. So, and that could be across EINs. So even though you have separate EINs for your 941s and your W-2s and everything, in the eyes of the IRS for PPACA reporting, applicable large employers are also part of a bigger group, of an ownership group, and really this determination of the ALE status has to be done across the entire ownership group. So even though they're separate EINs, you can't really get away with, oh, I've only got 45 employees per EIN. Well, no, the IRS says, no, we're not going to look at it like that. You got to add them all up together, and if you've got 50 or more, then you're an ALE member. And then the final example with seasonal employees, or final note with seasonal employees, I don't have an example of it, but I want to explain an example. The best, obviously, would be a beach grocery store where you have a flood of customers at certain times, one certain time of the year. So in the eyes of the IRS, it's really just 120 consecutive days. So you've got 4 months, 4 consecutive months. If you go above the 50 or more during those only 4 months, and you're under the 50 for the other 8 months, you're okay. You're not an ALE. You can basically say that these are seasonal employees. So an example would be if you have 8 months of 45 employees, and if I multiply that together, I don't know why that's coming up with a date. Let me do it this way: 8 times 45. These columns are formatted as dates. I come up with 360 employees there, but then my 4 months of 100 equals 400. And so when I total that up to be 760, and I divide by 12, so if I take 760 divided by 12, I've got, in total, I'm at 63, which is above the 50. However, it's really just because of those 4 months in which I've got a flood of employees seasonally. And so the fact that I have 8 months where I'm averaging 45 or 50 or less at this 45, then you're not an ALE member. So hopefully that makes sense. Let's move on to step 2. Oh, sure. Bonnie wants to finish up on that one.
Yeah, go back to this. Go back to this. Okay, so now we have finished up step 1, which is basically just determining if you're an ALE. Once you determine that, then we need to move on to step 2. Step 2 is basically determining if your coverage meets the required minimum value and minimum essential coverage and is affordable to the employees. So basically, our advice there is contact your health provider to find out if your plan meets all of those requirements. Similar to the 60-40 rule or the bronze plan that's offered on the exchange. Then the next thing to do will be to calculate the affordability to the employees. There's 3 harbors that can be used: a W-2 safe harbor, rate of pay safe harbor, and the federal poverty line. Basically, our report, or what we're going to show you here today, is using the rate of pay safe harbor. So with that, I'm going to let Chris continue.
Okay, so again, we're as Bonnie said, we're using the rate of pay safe harbor. So I'm going to switch back to the average hour spreadsheet and concentrate on the affordability column. So the affordability column let me switch over to data that I can use here. So, so the affordability column of this report, essentially what it does is well, let me go, let's see, which example do I want to use here? Let's just do it total for the year. I'm gonna use again my year look back period to make sure that I have some good data to work with. Well, okay, let me switch back here. So the affordability column U on our report, is essentially taking the employee's rate of pay, multiplying it by the 30 hours per week, or if it's a biweekly client, it's 60 hours, of course, and then multiplying it by the number of pay periods that the report was run for, not necessarily what the employee has worked. So if the employee worked less, we're still kind of taking it over the entire reporting period to say, okay, this is what the employee can afford. And then the affordability ceiling is that is the 9.5%. that we take, that's the ceiling factor. So, and again, according to the IRS, your ceiling factor for affordability is 9.5% of their rate of pay at the 30 hours per week. So the ceiling, all we're doing here is taking 9.5% of the previous column. And so this is essentially what you can charge the employees. And so what we have next is the total insurance over that same period as to what they have deducted. So, and then the average premiums is just dividing it back by the pay periods, which isn't used very often. But essentially what we have to do here is compare the affordability to the total period. You're looking to say, okay, can I spot any employees where there's some issues here? And so, like, for example, this employee, for whatever reason, their affordability ceiling is $128, but they've so far, or during this time period, been deducting $195. So we have to look at that employee, look at all these employees where we're in the negative here, where we essentially have a little too much. And again, we can only do this for employees that we have a rate of pay. So for salaried employees, they're going to look strange here because we don't have, we can't calculate an affordability ceiling because we don't have their rate of pay, an hourly rate of pay to multiply by the 30 hours. So we're going to look at essentially what you want to do, and in addition to what Bonnie was saying with working with your health insurance to make sure you have minimum value and minimum coverage, to make sure it's affordable, these are the kind of tools that FMS has for you to look at these employees. Okay, so let's move on to step 3.
Okay, so now up to this point we have determined whether we're an ALE or not. We figured out whether we have affordable insurance, so now we're going to move on to step 3. Where did I find that?
Oh, sorry.
And basically what that then means is to identify how you're going to keep track of all this information on an ongoing basis. The first thing you're going to need to do is determine these periods. There's a measurement period, administrative period, and a stability period. And the way I like to think of it is, the first one, the measurement period, is basically determining on an ongoing basis every year which of your employees are now over the 30 hours and will require an offer of coverage, and also the employees that are now under the 30 hours, which you no longer have to offer them coverage. So that's the first one, which is the measurement period. And I have based this example on a plan year that begins the first of the year. So an example of the measurement period would be from October 1st of 2013 to September 30th of 2014, which is 1 year. It can actually be from anywhere from 3 to 12 months. I think some of that is relief periods for the beginning of this. I think the standard is going to be the 12, so you just have to keep that in mind. So during that period, you pretty much do the same thing you were doing with the ALE reports and everything, figuring out who's over the 30 hours and requires an offer of coverage. Then you have the administrative period, and basically what that is what I consider or relate to open enrollment, where you're figuring out who those people are, you're making offers to them, and you're keeping track of all that information. And then you have the stability period, which is when they're actually on the coverage or will have the insurance. So the administrative period can be anywhere from up to 3 months or 90 days. And the stability period can be anywhere from 6 months to a year. The administrative period I have in my example here is from October 1st through December 31st, But the only thing you have to keep in mind, it's stressed everywhere, I'm not sure why, but if you have people that are on coverage, that have received coverage as of the beginning of the year, they would remain on this coverage through the end of the year. So the administrative period is just a time for you to do administrative work, basically. Figuring out who needs to be offered the coverage and who could come off, and getting things signed and all the stuff you do during open enrollment. And then the stability period is basically your plan year. And in my example will be from January 1 through December 31st. I have read where it can be up to 6 months to a year. I'm not sure if there's plans out there that can run 6 months or how that works, but I just wanted to bring it up in case it affected anyone. So that's basically how those periods are in place. I mean, when you look at it and you stand back and look at it, it seems pretty simple, but there is a lot of different people that have different plan years. So you would have to make all of these dates match what your plan year is. And you really don't have to stick to your plan year. I'm not sure why anybody would do that. I mean, you can pick your periods any way you like. It seems to me the easiest way would be to stick in this way, where you go through the open enrollment and your plan year. Okay, do you have something?
No, go ahead.
So you don't have nothing for that?
No, go ahead.
Okay, so the first one we're going to talk about is the initial measurement period. And basically that's where you're measuring those employees. $30 hours, and if not, you need to do the measure. And if so, you need to offer them coverage within the 90 days. Okay.
How potentially you can do that, it's pretty simple. Let me go back to the Excel version. So if I'm looking at a month's worth of days clearing filters, that's really, so to Bonnie's point on step 2 steps are similar, just because it's essentially measurement periods is what you're using this report for. Step 3, your measurement, you're determining really your open enrollment and what your entire plan year, who you're offering coverage for during the plan year. And then step 4 is really your new hires that are going to come on, and they need to be measured very quickly, and then if they are going over the 30, whether it was planned or not, they need an offer of coverage. So essentially, that's using this report, just different time periods. So again, for our open enrollment, we can use the 2014, let me clear my filters. We can use the 2014 year, so all of the data in the year, to essentially, again, go to greater than or equal to 30 hours. And I can filter all of the employees that need an offer. And then, of course, this is for the entire year, so I can filter out anyone that's been terminated as well. So if I want to terminate anyone that was terminated in prior years, I can do that just so I have a list going forward as a starting point for January 1, okay, who's active and who's averaging more than 30 hours during my look-back period. That was step 3. Step 4 is really on a month-by-month basis. So if I take February, for example, let me go over to February, for example, here, and I'll clear my filters again. Same kind of thing. So we're looking at the average hours column, and I can do a filter for greater than or equal to 30 hours, and then just look at who was hired in the month of February. So if I'm running this for February, and I don't see anyone with a higher date of February, so no one was actually, let me go, let's see, go over to my January. So for example, if I go over to January and I say, okay, just show me everyone, only those that were hired in January with a higher date here, then I can look at my average hours, also filter that for anyone that's greater than or equal to 30, excuse me. Let me do greater than or equal to 30. So no one's really coming up. So no one that was hired in January was averaging 30 or more hours during that month. So we could run it for 3 months prior. So if I run it for January, February, March, and I say, okay, anyone that was hired in January, show me only those employees that were hired in January when I run it for those 3 months, and then over those 3 months, what were their average hours using this column? And I can look at those employees and I say, okay, these are my new hires that I need to begin to offer, give them an offer in April, and then go from there. Okay, so let's move on to step 5.
Step 5 is pretty much just providing at the end of the year what you're going to have to do with all of this data, because since the IRS has mandated that you do this filing and provide coverage, basically what's going to happen now is that you're going to have to fill out what's called a 1095C or a 1095B. Those are given to the employees at the end of the year, similar to the W-2 process. They are also sent to the IRS. And what they're basically going to do is match those up to the employees and make sure that, because they will also get ones, the employees will get ones from like the exchanges. Anywhere an employee received health coverage, they're going to receive one of these forms. So at the end of the year, the IRS is going to have all those forms from all the health providers or who offered coverage to employees, and they're going to match that up to determine, do employees get penalties, do employers get penalties, and that kind of thing. So now we have to fill these forms out and give them to the employees by the end of January. We have to send a copy to the IRS by the end of February or March if they're going to be electronic. So Chris is going to show you how to get all that data in the forms.
So this is where a lot of the work comes in, and Bonnie was mentioning in the beginning, this is really where most clients should be on step 5. They're starting to determine, the offering coverage codes for the 1095C. And I can pull up a quick example of it. I'm sure you've seen it before. This is essentially what we like to call the healthcare W-2. It's coming up here in a minute, but so this is what the majority of clients are going to have to publish. The 1095B is in rare scenarios where the employer is not an ALE member and they're self-insured. Those are the employers that need to do the 1095B. That's small employers that are also self-insured need to do the B. The B is really just the covered individuals. Covered individuals is the IRS essentially to tell not only dependents but mostly, I believe, spouses, so they can say, okay, this person is on their spouse's health plan. So essentially, it's employee information at the top, applicable ALE, the employer information on the right, employee on the left, employer on the right. And then the nitty-gritty of this whole thing is part 2, the offer of coverage codes in line 14, employee share, lowest cost premium, self-only coverage. In 15, that's your bronze plan, and 16 is safe harbor codes. Part 3 for the covered individuals is only required for employers that are self-insured or self-funded. And you should know who you are if you are self-insured, self-funded, kind of synonymous terms there. The reason they need covered individuals for self-insured is because the health insurance company is not going to provide covered individuals to the IRS in the event of self-insured clients, employers, I'll say. So therefore, the employer is responsible for reporting to the IRS the covered individuals. So if you're not self-insured, then your health insurance company is required to report the covered individuals on the 1095B. The health insurance company is going to generate the 1095B. The employer is only required to do the 1095B if you're not an ALE and you're self-insured. So hopefully that makes sense. There's a lot of things to understand. The majority of our clients are going to need to generate these 1095s for their employees. It's due by January 31st, just like the W-2s. FMS iReporting module will essentially generate this form printed with all the data in it. And if you choose to have FMS print for you, it's going to be very similar to a W-2 where it's self-sealed, ready to be mailed. And so we'll package them up and ship them to you, and you can distribute them out to your employees. But it will be in a tear-off edges, kind of legal-size document that has this form and then the address portion, the envelope portion on the front. We just stamp it, seal it all together, and then it's ready to be mailed. It can either be mailed from our office, shipping is extra, of course, postage, I should say, is extra, or we can ship them to your office for distribution. So essentially, what FMS has developed, our reporting module, is really just a container for the data. We're not calculating any of the offering coverage codes. That responsibility is on the client to calculate the offering coverage codes by month for every employee, and then format it in a spreadsheet and upload it into our system. I'm not going to go through the upload in detail. We've done that in previous webinars. Really, what I'm going to do today is talk about how to use the average hours report in order to get the data, what we're looking for the upload. So there's a lot of different ways to do the upload. So let me give you an example of the data upload that we're looking for. It's really just columns A through I here. I've added some extra columns that I'll talk about in a minute that give me some notes and then just a hire and term date for reference as well. But I'm going to delete those when I go to create my final upload CSV file. So essentially, we're looking for client number, the year, employee number, a begin and end month, so we can do a range of months. And then for that range, what is the box or line 14, 15, 16, and then a yes-no flag if they were part-time. The only scenario where you would need to report for anyone that's not full-time is, again, self-insured clients will report part-timers that are enrolled in the health insurance plan. That's documented in the page 1 of the instructions for Forms 1094 and 1095C. But if you're not self-funded, self-insured, then you're really just reporting for full-time employees only. So I'm going to first start with a lot of assumptions here. I'm going to go with an employer that, for simplicity, for demonstration purposes, is offering a qualified offer. So that's code 1A, as opposed to the other codes 1B through 1F, where you have different levels of coverage for different individuals, where you have employee only, or employee and dependents, employee and spouse, employee, spouse, and dependents. A lot of different variations for codes 1B through 1F. And that's really where, once you get into those codes, that's really where line 15 comes into play. If you're using 1B through 1E, you're going to have to fill in line 14. Excuse me, loading it by month, where we're not really loading it as for a range of months, but we're really month by month, and then we're just keeping track of the transition. And when I say transitions, I'm talking and are going into a waiting period, the 90-day waiting period. If you have one, maybe it's 30 days, maybe there is no waiting period. If you start with a baseline of employees, we can really just going to I'm going to start with the 2014 data that I've been working with here for other purposes and previous steps. And the first thing I'm going to do, I ran this, recently, so I ran it in 2015, but I ran it for all the pay periods over 2014. So I'm going to include, I've got some data that's probably been updated since then, since the end of 2014 with hire and term dates. So the first thing I'm going to do is start out with anyone that was terminated in 2014. So for my starting point, if you were terminated in 2014, I don't care about you because I don't have to report you on the 1095. So I filter out that first off, and then I'm going to break it into 3 groups. I'm going to break it into my salaried employees and then kind of 2 versions of the 30 or more hours, the full-time employees. And that's basically if they were offered coverage or not. I mean, the salaried is the same way if they were, not offered coverage, but accepted the offer and they are enrolled in the health insurance. So kind of you have 4 groups. You have your salaried, who was enrolled, who wasn't, and then your 30 or more average hours, your full-timers, who was enrolled and who wasn't. So I'll get into a little bit more details on the enrollment, but let's just start with the salaried. And the easiest way to do that is just filter for only your 0 hourly pay rate. Okay, so once I do that, my 0 hourly pay rate, this is my salaried employees. And right off the bat, I can see that they're all over 40 hours because of this, I am tracking hours here, and so I can calculate an average over the pay periods. And let me filter out this 0 pay period. So essentially, I've got a list of employees here, okay? And so really what I'm doing is I'm just copying this list of employees, and then for my January upload, my starting point essentially, I'm just going to paste that list of employees in here, and then this is just January's upload data, so I'm going to do begin month 1, end month 1. And then what kind of coverage did I offer them? So theoretically, most employers, this is going to be always the same for all of your employees. There's rare scenarios where you're offering different levels of you're doing different offers to different employees, but the majority of the time you're doing the same. So for, again, simplicity of my demonstration here, I'm just going to assume that I'm offering the same type of offer to all my employees, and that is a qualifying offer. So I'm using code 1A. And so then box 16, my 2C code is employees that were enrolled in the coverage. So if I go back to my starting point, obviously this would be something like if your plan starts January 1st, your health plan, you do an open enrollment and you've got everyone. But I can see here that that they all have insurance premiums, okay? So they all have deductions, health insurance deductions, and therefore I can conclude that they're enrolled. And so then on my upload, I can give them a 2C. Then obviously if anyone wasn't, I would just, instead of the 2C, I don't really need any code, and I'll talk about that when I get down into the full-timers. So that's why I put a note here that says, okay, these are my salaried employees. Now for my full-timers, again, I'm going to go back to my raw data for 2014, and this time I'm going to filter out my salaried employees. So I'm going to take out the hourly rate of 0, and now I'm going to go to, and also my terminated in prior to the beginning of the year. And now I'm going to go with average hours of greater than or equal to 30. So we've used this method for previous steps, but this is essentially giving me a list of employees that have average hours, again, let me go back here, greater than or equal to 30. So of these employees who was enrolled at the end of the year or beginning of the year, so I can look at, again, the insurance premiums here. So if I filter only for employees that did not have any insurance, I'm left with a list of my full-timers, 30 or more employees, that do not currently, at the beginning of the year, did not have a health insurance deduction. So then I can switch over to my January upload data spreadsheet, and I can paste in that list of employees, again, January to January month, begin and end, and I'm offering them a qualifying offer because they're a full-time employee, but they're not enrolled because they don't have a deduction, and so I'm leaving line 16 blank. There's really no safe harbor code on line 16 that says they did not accept it. It's really just they weren't employed, not a full-time employee, or they were enrolled. And then you get into your safe harbor. Those codes are really just if you're not using a qualifying offer, if you're using 1B, 1C, 1D, or 1E. Chris Cooley's last website, Chris Cooley from My HR Concierge, did a great write-up and overview of scenarios with calculating the different codes. I'm not going into calculating the codes. Really, clients should be able to do that, and if you need help, I'll talk about it at the end, but Chris Cooley is available and his team. But for this scenario, I'm really just looking for, I've already determined, what to apply, what codes to apply to my groups. I'm really just looking for, okay, who's in those groups? So this group, the second group that I just did, was 30 average hours, but no insurance deduction. And then I can turn around and just flip-flop my insurance premiums. Instead of selecting the 0, I select everyone that's not 0. And now I'm left with a list of employees that, again, are 30 or more, active as of the beginning of the year, that did have insurance. So I can copy this employee list and paste it again over to my January upload. And that's really all of these employees here. So I labeled them 30 average hours, and they have insurance. And so now, for this group of employees, I'm back to giving them a 1A and a 2C. Okay? So now, again, from here on out, now that we have a starting point, what we will do is just simply copy this list of employees and paste it into the February upload, which I've done here. And then when the month comes, and then basically just handle my transition employees. So going back to, let's say we're working with employees that were hired in January. So we're always looking a month ahead, because even though they were hired in January, we have to test them for 30, 60, or 90 days. So let's say, for example, that they were using a 30-day waiting period or testing period for the health insurance. If we look at the, let me go to the January raw data, and I can filter for anyone that was hired in January. So I'm just going to do that. So here's all my employees that were hired in January. And then let me get rid of this extra day at the bottom that we were doing before. And so here's their average hours. And so I can see right away that during this month, no one was averaging 30 or more. But I do have an employee that was very close, and it just so happens that we labeled them a full-time employee. So this is kind of one of those exceptions that you need to say, okay, even though for this month, in actuality, they didn't get over 30, we know that they're designated as a full-timer and designated that they are going to get over 30, so we probably should put them in the January upload as their, or I should say the February upload as they're going to get an offer of coverage. So again, we're looking at we ran the average hours report for the month of January. We're going to look at employees that were hired basically at the beginning or the prior month. We're always looking 1 month ahead because it's that waiting period. So employees that were hired in beginning, like January 1 or in December, you've got that 30-day testing period or 60, 90, whatever the testing period is. We look at that average hours for that time period and for those employees, the new hires, and then we add them in to the upload whenever to those prior months and fill in those employees. But our printing programs will assume we will check their hire date, and if they have blanks for months prior to their hire date, we are going to default the line 14 code to say 1H, there was no offer, and line 16 of 2A, they were not employed. So no, you're not required to go back and fill in the previous months for your new hires. And then your other transition is your terminated employees. So again, I can just filter, and let me do February, for example. I think I have some good term dates here. If I search for, okay, only show me employees that were terminated, oops, and no blanks, only employees that were terminated in February. So usually employers, or according to the IRS, forget which one, you'll usually offer coverage to the end of the month. So employees that were offered or were terminated in February, February would be the last month on the upload data that they're actually getting an offer. So you can see here, I did January, and I said, okay, this is my February upload on month 2 to month 2. Employees that were terminated in January, for February upload, I'm going to do a 1H. They're no longer employed, and 2A means 2H is no offer, and 2A, they're not employed. So we're keeping track of the transitions. So the new hires, the terminations, and then if you're using a waiting period, there's a safe harbor code for the waiting period 2D. So for the months that they're in the waiting period, we can apply a safe harbor code of 2D when we have 1H, which is no offer. And so again, the trick would be to just take this entire spreadsheet that we've done for February and just go ahead and copy it. I'm going to move it to the end, create a copy. Let me get rid of my March raw data, move that over. And instead of February, I'm going to rename this to March. And so now I've got a baseline for March. And so now I'm just looking for, again, transitions in March. Those employees that were hired, 30, 60, 90 days ago that are coming out of their waiting period, or new hires immediately in March that are going straight into their waiting period, or employees that are terminating that that are terminated in the prior month that now in this new month they're no longer getting an offer. So obviously, for example, this employee that was terminated in January, every month, because we're copying it every month they're just going to stick with that 1H, 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 1H every month. Or employees that are not in any sort of transition, they're just standard employees that's staying employed for the entire year. They're just going to stick with their 1A or whatever code, box 14 codes you're giving them, and all of the codes you're giving them really. They just get copied through with each spreadsheet. So again, we're really just establishing that baseline, and then we're looking for transitions throughout the year. Okay, that was Bonnie. Why don't you go ahead with step 6. It's pretty short one, I think.
Yeah. Step 6 is basically just now, once you have the forms to the employees, you also have to have them, get them to the IRS. And Chris could probably talk more about that. I think we're in the process of trying to develop a file that will allow you to do that.
Right. So we'll have, we have a release on October 15th. You should have received an email today about the October 15th release, where we're going to begin, we're deploying the print programs. So for clients that will print their own forms and not utilize FMS, you'll be able to begin test printing the forms. We'll have both sealer and non-sealer versions. And then our Q4 release will have the electronic filing for the PPACA forms. So there's, just like the EFW2 file, there's an electronic file for the 1095 as well as the submittal form, the 1094. So we'll be able to do that as well. We'll be able, essentially the reporting module will generate the file. We just got the specs, and so we're still developing the programs to generate the electronic file. The IRS is really late in publishing the file layout specification, so we're in development on those. The printing programs will be out on the 15th, and then you can essentially perform that step 6, which would be printing the forms and filing with the IRS. So we didn't do the slide, but that's pretty standard thing. The last thing I want to talk about is a quick advertisement, because Bonnie and I are really just talking about utilizing the FMS tools. We're not really answering questions as to okay, which code should I be using? Should I be using 1C, 1D? And I'm sure you have a lot of questions. We've partnered with my HR concierge and Chris Cooley to assist our clients in doing so. You can utilize his services to sort of answer questions, and he does a lot more. You can see Affordable Care Act compliance is just one of the many things that they do. But for we know there's a lot of specific questions, because Bonnie and I were just running through very simple explanations of, or simplified example scenarios, but everyone has their own sort of different way to do things and different way to calculate these things, and a lot of questions can arise from that. That's where we recommend our partner and my HR concierge to sort of assist clients with making the decisions as to, okay, I have this group of employees, exactly what codes should I apply to them. So we've got his contact info here. We'll send this PowerPoint presentation out to all the users that attended the panel today. We hope everything, we hope that we gave you a lot of good information here, and hopefully you can understand where you should be at in this process, what you should be doing, and how you can utilize the FMS tool. Bonnie, do you have anything?
Yeah, I just want to add to what Chris's comment there about what step you should be in. You want to try to make sure you get all this data gathered as soon as possible, so that we can start getting it uploaded. I wouldn't wait till the end of the year to do that. I mean, it's going to be
a lot of work.
A lot of work.
Yeah, you definitely want to get started now.
And the other thing I wanted to mention is that is for the 2015 year reporting. If you looked at my measurement and stability and administrative period chart, you should actually be starting right now for 2016. So you should be measuring your 2015 data and finding out who's over the 30 hours, so you can give them an offer at the beginning of this January, if those are how your plan years work. Okay, that's all I have. Okay,
well, thanks everyone for attending. If you have specific questions, my email, Chris P at FMS Solutions. Bonnie's is Bonnie K at FMS Solutions. We'd be happy to answer questions on anything that you may have. Thanks a lot. Enjoy the rest of your day.